All right, this is the chart of U.S. oil. I don't usually make videos like this. Well, I make videos like this often for friends, but I've never made one for public consumption. But I thought this was really relevant. There's so many points of confluence on this chart, which is what we look for as traders to make sound decisions based on probabilities. This is, like I said, it's U.S. oil, and this, of course, is of relevance because of the current war in Iran. And this is a scary chart for anybody that has to buy gas, which is just about everybody. This is a head and shoulders pattern that I have mapped out here. This is a shoulder, head, other shoulder, left shoulder, head, right shoulder. This is what's called an inverted head and shoulders. And you see this resistance line here, this upsloping trend line is actually a point of resistance. Price keeps coming up here and kissing it and getting rejected from it. And head and shoulders patterns are notoriously reliable, especially if they take place over this type of a time frame. I've never seen an 18-year head and shoulders pattern. I think we may have recently had something similar in gold, and you've seen what happened to that. Although I'm not a gold person, I don't follow gold. But just wanted to show you on this chart what it is we may be in for. Sometimes the charts have the ability to foretell the news. But let's get rid of this head and shoulders that I drew on here for now, just so we can see the chart. Now, this is a monthly chart. These are monthly candles. So this is going, it right here is about 18 years ago, around the 2008 financial collapse. But there's several things I see here. First, the head and shoulders, obviously. We have no volume profile to work with because this is a futures market. So we can't confirm that it's a perfect textbook head and shoulders. But the way head and shoulders works is you take a measured move from the lowest point down here, which would have been the COVID low, where oil actually went negative. I watched that live. That was wild. It went down to, I think, minus $36 a barrel because nobody had anywhere to put it. There was a glut of it. But if you take and put a line in here, measure this distance from down here at the COVID low up here to this upsloping resistance line, the neckline, they call it, of the head and shoulders pattern. And you take that and you move that up here to a potential point where price may break out above that line. It's going to bring you to a scary place. It brings you all the way up here to almost $250 a gallon, or $250 a barrel for oil. But it doesn't stop there. There's more things on this chart that are disturbing. This is a Fibonacci retracement that I put on here. And from the COVID low to the run-up we had in 22, we had a perfect 618 golden ratio, a Fibonacci retracement of this from swing low to swing high. Down here to this swing low, we got a perfect 618, which is textbook. That's what traders use to base their trades on, is the Fibonacci sequence. But this is what's called a bull flag. You have this run up, price consolidates, and then if it breaks out above this upper line here, this white line, you're off to the races generally. And there's a measured move that can be taken from a bull flag. You go down here to the swing low, come up here to the swing high, you take this line you just drew and you bring it up here to around where a potential breakout point would be above that resistance line on the top of that bull flag, and that brings you right up to almost exactly the same target. Just a bit scary. And there's one other thing. Let's get rid of this Fibonacci retracement, and let's do a retracement from the swing high here down to this swing low. Now, when markets get real crazy, they can go up all the way up here to the 1.618 Fibonacci retracement. But if they get real nuts, they can get all the way up here to the 2618 Fibonacci retracement. And the 2618 lines up absolutely perfectly with those measured moves. I have never seen, well, maybe a couple times, but it's very rare that you see this type of confluence on a chart. So many factors pointing to the same place on the chart. And the thing that's most disturbing to me about this is during the day, I conduct a business that relies on trucking. And we just, in this country, had passed that non-domiciled truckers act that gets all the non-domiciled truckers off the road. And that's going to affect things, obviously. It's going to make freight more expensive. Although it's I agree with the law. It's a good thing. But if you couple that law up with $250 a barrel oil, shipping is going to, inflation is going to explode. Let's just hope that this chart is wrong. But it is my contention that charting rarely lies, especially when you're dealing with a pattern over this many years. This is scary stuff, my friends.